Yahoo paid $5.7 billion for a company that had never once turned a profit. The deal made Mark Cuban a legend, but that is the wrong story. Here are the actual numbers. Broadcast.com had $19 million in annual revenue. It had 570,000 users. Its servers could barely handle 200 simultaneous connections. Yahoo valued each of those users at roughly $10,000, more than the cost of a used car, for a streaming service with chronic quality problems. 2 months before the deal closed, Broadcast.com hosted what everyone described as its defining moment, a live webcast of the Victoria's Secret fashion show. 1.5 million people tried to watch. Most could not connect. The sound dropped. Engineers scrambled. The platform collapsed under the traffic it was supposed to prove it could handle. Yahoo bought it anyway, for $5.7 billion, announced pointedly on April 1st, 1999. This episode is not about what Yahoo paid. It is about the man on the other side of that transaction, and about what he had already quietly arranged before the ink was dry. But before any of that, before the billions, the bubble, and the billionaire, there was someone else entirely. His name is Cameron Christopher Jaeb. Most profiles of Mark Cuban do not mention him at all, the ones that do give him a single line. But the story of Broadcast.com begins with Jaeb, not Cuban. In 1994, Jaeb was not a tech mogul. He had no venture backing, no Silicon Valley network. He was a broadcaster who had been watching something happen. The internet was beginning to carry audio. Not well, not reliably, but it was happening. And Jaeb believed that if you could stream live radio over a dial-up connection, you could change how people consumed sound. In April 1995, a company called Progressive Networks released the Real Audio Player. For the first time, compressed audio could travel over a standard 28.8 kilobit modem. The quality was thin. The connections dropped constantly. But it worked. And Jaeb had already been building toward this moment. He started with one server and one ISDN line. His platform, Cameron Audio Networks, was so fragile that it could handle almost no traffic at all. But he began signing content deals, college radio, college sports. By December 1995, he had locked in a 2-year agreement with Learfield Communications to stream live college basketball games across the internet. He was the founder, the one who saw it first, the one who built the first version, the one who knocked on the first doors. Then someone introduced him to a Dallas attorney named Todd Wagner. Wagner wanted out of law. He thought the idea was interesting. And Wagner had a friend. That friend's name was Mark Cuban. He was 35, recently liquid from selling a software company called Micro Solutions, and looking for his next move. Wagner arranged a meeting. Cuban heard the pitch, and by most accounts, within minutes, he said he was in. Nothing that followed was quite what Jaeb had expected. Cuban's entry into the company was not straightforward. It started improbably with a $10,000 check. According to accounts drawn from early investors and Jaeb himself, Cuban wrote that check to Jaeb with 2% of the company written on the memo line. He later claimed it represented a non-dilutable stake, meaning that no matter how many new investors came in, his 2% would stay 2%, untouched. That claim created a problem. If Cuban's stake could never shrink, anyone else who bought into the company would see their share diluted, while Cuban's remained fixed. Outside investors would not accept those terms. Funding became nearly impossible. By spring 1995, the pressure had built to a breaking point. Cuban told Jaeb and Wagner directly that he would develop the company with or without them. That was the moment. Jaeb had two options: lose the company entirely, or accept a deal where he stayed but gave up control. He accepted the deal. The company was reorganized and renamed AudioNet. Jaeb took 10%. Cuban and Wagner split the remaining 90% between them. Jaeb was given a salary and a defined operational role. He would keep working, but he would not be steering. In later interviews, Todd Wagner described Jaeb's involvement as lasting a very brief period of time, and said he had owned a slug of equity and did just fine. What Wagner did not say was how that slug had been structured, or how much it would eventually shrink. From this point on, AudioNet was Mark Cuban's story to tell, and he would tell it brilliantly. Over the next 2 years, AudioNet grew. Cuban and Wagner secured more broadcast rights, sports, radio stations, live events. They were aggressive, relentless. The product still had real limitations. Streams buffered, connections dropped. But the vision was compelling and the timing was extraordinary. In 1998, the company changed its name from AudioNet to Broadcast.com. Simpler, more universal. And on July the 18th, 1998, it went public. What happened next was a preview of the world the country was living in. The IPO price was set at $18 a share. By the close of the first trading day, shares were at $62.75. That was a gain of 249% in a single session, a record at the time for any IPO in American history. The market valued the company at roughly $1 billion. Consider what that company actually was. In 1997, its last full year before the IPO, Broadcast.com had generated $6.9 million in revenue and lost $6.5 million doing it. It had never made money. It had an accumulated deficit nearing $13 million. And it was now worth $1 billion. The ratio was not unusual for 1998. It was simply the air everyone was breathing. Investors were not buying what a company had built. They were buying what they believed a company might become. And Broadcast.com had a gift for making people believe. For Mark Cuban, the IPO was confirmation of something he understood better than most. The market had decoupled from reality, and he had a front row seat to watch it happen. By early 1999, the atmosphere in Silicon Valley and on Wall Street was unlike anything that had come before. Companies without revenue were raising hundreds of millions. Companies without products were going public. The logic of the market had shifted. If you were on the internet, you were the future. And if you were the future, ordinary financial rules did not apply to you. Broadcast.com existed inside that logic perfectly. In February of 1999, it hosted the Victoria's Secret fashion show as a live webcast. 1.5 million people tried to tune in. Many could not get a connection. The video froze. The audio dropped. Engineers stayed on through the night trying to hold the platform together. And when it was over, the story that ran was not about what broke. It was about how many people had tried to watch. The narrative wrote itself. Broadcast.com was the future of media. Yahoo believed it. And on April the 1st, 1999, April Fool's Day, Yahoo announced it would acquire Broadcast.com for approximately $5.7 billion in Yahoo stock, about $130 per share. Broadcast.com had been worth $1 billion less than a year before. It was now worth nearly 6 times that. The company had $19 million in annual revenue. It was still losing money. The market was paying roughly 300 times annual sales. For Cuban and Wagner, the deal was everything they had worked toward. For Chris Jaeb, it meant something different. His 10% stake, the one he had traded away his company's control to secure 4 years earlier, had been diluted by new investors and option grants down to less than 1%. Now comes the part that most people do not know, the part that actually explains why Mark Cuban is worth billions of dollars today. When the deal closed in July of 1999, Cuban received approximately $1.4 billion in Yahoo stock. Not cash, stock. And because of the terms of the merger, the lockup period that was standard in acquisitions like this, he could not sell those shares for several months without triggering violations. So, he was sitting on $1.4 billion in a single tech stock at the absolute peak of the largest bubble in American history, and he could not touch it. Most people in that position would have waited and hoped. Cuban did something else entirely. First, during the lockup, he spent over $20 million, everything he says he had at the time, shorting internet index funds in which Yahoo represented less than 5% of the total weight. He was trying to offset his exposure without directly shorting a stock he was locked into. He lost every dollar of it, but that was not the main move. It was just the bridge. When the lockup expired, Cuban went to Goldman Sachs, and together they built what Wall Street later called one of the top 10 trades of all time, a zero-cost equity collar on his Yahoo position. Here is how it worked. He bought put options on Yahoo shares with a floor of around $85. That meant even if Yahoo's stock went to zero, he could still sell his shares at $85. At the same time, He sold call options with a ceiling of around $205. That meant if Yahoo kept climbing, whoever held those calls would take the gains above $205. The cost of the puts and the premium from the calls roughly canceled each other out. Zero net cost, and a guaranteed floor. Yahoo stock peaked on January the 3rd, 2000, at $118.75 per share, the highest it would ever close. Then it began to fall. By the end of 2000, Yahoo shares had dropped 87% from that peak. By September the 26th, 2001, they closed at $8.11, 93% below where they had been. Investors who held Yahoo through those years, and there were millions of them, watched most of their money disappear. Cuban's collar held. He converted his protected shares into cash over the following 2 to 3 years. By his own estimate, he personally made approximately $3.5 billion from the Broadcast.com deal in total, not $1.4 billion, 3.5. He made more from hedging the Yahoo stock than he had made from building the company. While Cuban was building his financial wall, Yahoo was trying to figure out what it had actually bought. Broadcast.com was folded into a division called Yahoo Broadcast Services. Todd Wagner stayed on to run it. The idea was that Broadcast.com's streaming technology and audience would be the foundation of Yahoo's move into broadband, the next generation of the internet. It never worked. The integration was difficult. The technology was already showing its age, and the advertising market that was supposed to fund everything was about to collapse along with the rest of the dot-com economy. In May of 2000, Todd Wagner left Yahoo entirely, walking away rather than accept a role as the company's chief operating officer. He had been there less than a year as an employee. 2 years later, in 2002, Yahoo shut down most of its broadcast services. Broadcast.com, as a functioning platform, ceased to exist. The streaming pioneer that had never been profitable was gone. Yahoo had paid $5.7 billion for something it used for 3 years and then turned off. Meanwhile, on January the 4th, 2000, 4 days after Yahoo stock hit its all-time peak, Mark Cuban paid $285 million for the Dallas Mavericks, cash, from his protected Yahoo windfall. He was buying a real asset, a franchise with local monopoly characteristics, something that could not be replicated. Here is the acidic fact at the center of all of this. In 2016, Verizon acquired all of Yahoo, the entire company, the search engine, the media properties, everything, for approximately $4.5 billion. Less than Yahoo had paid for Broadcast.com alone, 17 years earlier, and Chris Jaeb, the man who built the first version of the platform, the man who saw the opportunity before Cuban, before Wagner, before anyone. By the time the Yahoo deal closed, his stake had been diluted from 10% to approximately 0.3%. He received roughly $50 million. Cuban received approximately $3.5 billion, 70 times more, for the same company, from the same deal. Something is right there, in plain sight. It is tempting to call this a fraud, or a con, to look at what happened to Chris Jaeb, the man with the original idea, the original infrastructure, the original deals, and conclude that something was stolen. But that is too easy and probably too simple. Nothing Mark Cuban did was illegal. He made aggressive business decisions in a climate that rewarded aggressive business decisions. He saw the exit before most people saw the bubble. And his hedge, the collar, the protected floor, was not a secret. It was disclosed. It was legal. It was brilliant. The discomfort is not with what Cuban did. It is with what the system rewarded. Jaeb had the idea. He built the first version. He made the first deals. He did the work that made the company possible. He left with $50 million. Cuban had the leverage. He controlled the capitalization. He timed the exit. He built the wall when the collapse was coming. He left with $3.5 billion. This pattern has a name, not a criminal name, just a name for what happens when the person who creates something and the person who finances it are not the same person. And when the contract between them is written at the moment, one side has all the power. Broadcast.com is remembered as a landmark of the dot-com era, a testament to internet ambition, a company that saw something real before the rest of the world did. Maybe. Or maybe it was a company that one man used to fund a retirement, and another man built so that first man could sell it. The answer, like most things from that era, depends entirely on who you ask and who you remember.